Well, hello, good morning, good afternoon, good evening, wherever you are. Welcome to Breakout Trading Answered, the show where we talk about all things breakout trading. And of course, joining me today is breakout trading specialist, Mr. Tomas Nesnidal. Welcome, Thomas.
Welcome, everybody. Thank you. Thank you, Andrew, for the great entry. So we almost didn't make it, but we did make it at the end of the day. So I'm so glad we're here.
Yes, that's right. We had some very last minute tech issues with my internet connection, but it looks like it's working now. So fingers crossed, everyone, we can get through the show with no technical issues today. But today, Thomas, is a very exciting day.
Why is that?
Now I know you're get very excited counting up to Christmas, and it's like 10 or so days until Christmas. I know you love sitting under the tree unwrapping all your Christmas presents, but that's not what I'm talking about. Any clues what today could be? Or perhaps maybe I should give you a clue. This episode, what is it?
We're going to talk about markets.
Oh no, close. This is the fifth show in our five episode series. So we're at the last one, right?
Already?
Yes.
Oh, wow.
Can you believe it? Can you believe it? I can't believe it's gone so fast.
That passed so quick. Yeah, that's gone so fast.
Exactly.
Great. So who's here tonight with us?
So we've got a good morning from Dave. Good morning, Dave.
Oh,
good to
hi,
see
Dave.
you here. J.A., I'm not sure who J.A. is. Could that be our friend? What's the Czech name that I always get wrong?
Oh, Jirka.
Jirka. Could that be Jirka? I'm not sure. So anyway.
Could be Jirka, yeah.
So let's get started because I wanted to do a quick review of the last 4 episodes, and then which will lead nicely into what we're going to talk about today. G'day, Dan. Good to see you. And Chris, greetings from Oregon. Good to see you here. So, as I mentioned, this is the 5th in a 5-part series. The first one, we talked about 5 ways to finish your trading year strong. The second one, 6 top tips for better algo breakout trading. The third one was build breakout strategies that actually work. That was a great one. And the fourth one, which was just 2 weeks ago, 7 reasons you should trade breakout strategies now. So, Thomas, I'm really excited to see what we're going to wrap up this 5-part series with today. What do you think we should talk about?
Yeah, we're going to talk about markets, right? And this is quite important because to me this is sometimes a little bit funny because for me making income in trading it's kind of like where all the parts need to fit together. So it's a little bit like let's use this phrase holistic approach. And when we have this goal or intention to create a full-time income with trading, we have to consider all the aspects. It's not just the obvious stuff like software and hardware, and then the even more important stuff like which trading direction I will pursue it, or which kind of logics I will use, and entry points and exit points. But it's also which kind of market I'm going to trade, and it all goes together. And you cannot really, like a lot of traders, they do this decision. Oh, everybody trades forex, so I'll trade forex, and that's not easy. That's not really the way it works. It's not like that because everybody else seems to be trading forex, you should trade forex as well. It always starts with your intention and what your intention is. And for every intention, we have different vehicles. And I'll talk about it, but you need to understand first what you really want to achieve. And based on what you want to achieve, you need to really carefully choose what your vehicle will be, trading vehicle. And now, I assume, at least that's my assumption, most of our viewers, maybe hopefully all of them, I assume, would like to create a stable trading income, right? Like that's why we are here in this industry, because we want to create a secondary, primary, retirement, whatever income, but we want to create a stable income. And that's very, very important to understand, because that will give you completely different selection of vehicles compared to, let's say, just playing or, being bored and doing something which will give me a lot of emotions, or speculating. And if we want to create stable income, and this is the first intention, then how do you really do it? How do you do it in trading, right? And traders think that you do it with great strategy, like you have one great strategy, you put it on some market, and then you will have this stable income, which of course it's absolutely it's a fairy tale, because that's not how stable distribution of profits and stable income is achieved. Every strategy has got its just shelf life. It can fail. Anything can happen with that strategy. So you must not think this way. Like, if you want to create a stable income, the totally key element for stability is diversification, right? So that's the essential. Like, you can't just give me one single idea how you could potentially create stable trading income without diversification. I haven't figured out yet. I used to have a lot of silly and naive and amateurish ideas 15 years ago. None of them worked out. So give me an educated guess on this one. Is there any other way besides diversification? Something I'm missing?
I can't think of anything other than a crystal ball. That might
yeah,
work.
yeah. That might work. Exactly. So that's the essential. Like, you need to understand that if you want to have stable income, you have to have diversification, period. Like, I still need to be proven by somebody that there's other way. I don't know about that way. And now, when you really have this intention of creating stable trading income, and you know that the key is diversification, or hopefully you know it, then the next question is, how do you achieve diversification, right? Like, how do you achieve diversification? So first of all, what are your options when it comes to diversification? So your options are to take one market and then create multiple different strategies on that given market. Well, that's not a bad start. I mean, that's already something. That's better than one market and one strategy. That's at least a pursuit of this idea of diversification. Yet it is still half diversification, because if you want to create a rock solid diversification, you need to utilize every tool you have. And now you have two different tools. One tool is the strategy, and the second tool is the market. So why would you really limit yourself with diversifying only with different strategies among one market, when you can really diversify with a lot of strategies among a lot of very different markets? So if you want to achieve diversification, then you need to consider completely different markets, and you need to consider also different strategies. It can be the same trading direction, like breakout trading, but yet have a little bit different logics and have different markets. And now we're talking about diversification as an essential element of stable income. Does it make sense so far?
Yeah, we've actually got a comment in the chat from YG. Let me put this one up on the screen. The other way is to go volume on the very strong idea, or go big volume. I think this was posted in the stable trading income section, perhaps. What do you think about that idea?
That's not stable income. That's speculating, sometimes even gambling. You think you have strong idea. That strong idea can be strong for 5 minutes, 5 days, 5 months. But what happens when that strong idea gets weak? Because every strong idea gets weak sooner or later. Even my very best trading ideas ever had some peak life, especially my strategies. So again, that's not an answer. You cannot increase volume on one. What if that strong idea becomes weak exactly the moment you launch it? And that's very, very often the case. It's more often than anybody is willing to admit. Then what you do? Well, nothing. Hopefully you have another 5 strong ideas, and you still have this diversification, and that will save your one a considerably strong idea turning into weak idea. So again, volume on one strong idea, that's not stable income. That's speculation and sometimes even gambling. So if we want to be serious, we need to diversify. So let's get back to diversification. So we know we want to diversify because our strong ideas can very quickly become weak ideas. Now, the best way to, how do we achieve good diversification? And the answer is correlations. It's all about correlations. And that's really something super important to understand. Today, we're living in a global economy, and you see it everywhere. When there is something wrong happening in economy, there is this massive effect of interlink in the economy, in linearity. We call it linearity in trading. And when things go bad, everything usually goes bad. So you see all stocks go down, real estate goes down, whatever else, bonds can go down. That means that we're living in a times of highly correlated vehicles. A lot of vehicles are more correlated than we're willing to admit. Yet, if we want to achieve diversification, our primary aim still needs to be to trade among low correlated vehicles. So we really need to have low correlated vehicles that can support us in basically any economical scenario. That's the way. And now this is the key part. If we know we need low correlated vehicles, what are our options? And now it's getting really interesting, and I think very few people go really deeply enough to consider what truly our options are. So option number one, stocks, very popular. I think stocks trading is great, don't get me wrong. But I think that stocks trading is great only when everything goes up. When things turn down, I think there is barely anything in the world more correlating than stocks. Like I've seen that many times. Stocks are horribly correlated, especially in crisis, especially when things go bad and go down. Everything is heavily correlated, and make money on stocks in down markets, it's, I would say, impossible. It's impossible. So stocks are, you can diversify among a lot of stocks, but basically these stocks are highly correlated. So it's very weak vehicle to really secure stable income, especially in times of crisis. Next option, forex. Well, similar story. You have 6, 7, maybe 8 pairs, tradable pairs. There's also a lot of mutual interlinking between different currencies. So it's difficult. It's a way more interlinked. Like in today's economy, everything this is way more interlinked than we're really willing to admit. So forex is super difficult to diversify among as well. Cryptos, super correlated. Like it just Elon Musk's gets on TV. He says one thing about crypto, all the crypto goes down, period. Like no exception. So it's probably the most correlated market right now. And it's a speculative market. I still wonder how anybody can even think about making stable living from crypto. I mean, this thing goes 50% up in one day, 50% down the other way. So it's a roller coaster, it's emotional roller coaster. But how do you secure monthly stable income from this? Impossible, totally impossible. So all these are not good vehicles. So we're left with the last option, and that is futures trading. And futures trading, at least from my vast research and understanding, is right now still the only way to achieve good diversification. And the great thing about futures is that we really have completely different categories. We have indexes, bonds, grains, meats, softs, metals, and I'm sure I even didn't name all of them. And these markets are really they have the lowest mutual correlation out of all markets you can find. Just take 100 stocks or 50 stocks and have a look on randomly and have a look on 10 years correlation, especially when markets go down, and the correlation will be rather high. Then take randomly 5 futures markets, from different categories, futures categories, plot your long-term correlation, and it will be completely different story compared to stocks. So that's where we still can benefit from low correlations. We can take completely different vehicles with completely different behaviors. Sometimes they are independent to each other, but sometimes they're totally independent of each other. We can create different strategies on these vehicles, and that's the way how we really do our best to secure stable income. Period. Like, prove me I'm wrong, please.
I think you said a really key point there, Thomas, which I think a lot of traders miss when they're looking at correlations, is that they don't they don't focus on the times when you want low correlation to actually be a benefit, like in times of market crisis, where it seems like a lot of stuff just goes down. They behave in very similar way. People kind of look at correlations over maybe like a 10-year period, which then obviously reduces the moments in time when you need that correlation to take effect. So what you just said there about looking at the correlations in times of crisis, I think is really key, and I think that's where a lot of traders go wrong in their research, is that they're looking at the entire period rather than when they actually want the correlations to help them.
Yeah, that's a great point. And I personally think that most traders don't even think about this. I think that there is this tendency, just kind of follow the herd, like what's the hottest is the greatest, right? Like now everybody talks about crypto, so let's trade crypto. But really, what is it I want to achieve from my trading? I can trade crypto, no problem. It's a great speculative vehicle. But do I want to speculate? Do I want to be hero one day and end up on the trading graveyard just weeks later? Because that doesn't make really sense. Like, this is a serious business. I want to create a serious income. I need to live from that. I need to have as many winning months as possible. I need to provide. I need to pay rent, whatever. And you cannot do this with speculation and roller coaster. You need to do this with a very reasonable, professional way to do that. And that professional way is really being diversified. And all the biggest companies in the world do that. Like, let's have a look on, let's say, what is that Unilever, right? Like Unilever, they're diversified among, it's everything. Like, just if you look at portfolio of Unilever, it's just everything. Like, they really diversify. They know what's selling in crisis. They know what's selling in good times. They know what's selling in different markets, in different countries. So they constantly diversify, that they make sure they always in each situation will be at least selling something. And that's the point of trade as well. Like we need to make sure we will be making money in every economical situation, not only when everything goes up and I will feel like a hero. What will you do when things will go wrong? Well, when things will go down? And that's where we need to understand that correlation is the key and diversification is the key.
Yeah. Another good example of that, I guess, is Amazon, right? They started out as a little internet bookstore, and now look at them. You can get anything there, basically. And they don't just do the store. They've got the technology side and a bunch of other things that they're doing. So that's also another good example of diversification. Now, I know you've actually got some slides to show, to compare futures with other instruments. Do you think now is a good time to go through those?
Yes. Just Yeah, that would be great, because I
can put it
prepared
on
the
the screen.
strategy for review. Yeah, so I prepared.
One moment. We've got a couple of good questions in the chat as well, which we'll get to just after these slides. So there we go.
Yeah, I really want to prove my point, right? Because people still don't believe me. They like people, a lot of especially beginning traders, they still believe that where the majority goes, that's the right flow, and what's the latest is the greatest. So this is the first slide I prepared. This is from AXS Investment. And this is quite interesting because this shows how futures, managed futures, and managed futures is nothing more or less than a portfolio of strategies being traded on commodities, on futures markets, how it behaved compared to other stuff when the first strong COVID-19 shock came last year in, I think it was February or something like that. And you can see that everything went down, like equities went down and the stocks went down, S&P went down. So the vast majority of tradable vehicles nowadays are exactly like this. They're very vulnerable to sudden market shocks. But have a look what happened with futures. Like futures, almost nothing happened to futures. There was a just slightly small bump down, then bump up, but it went mostly sideways. And now imagine when there's blood on the street, when everybody's losing money, and all these actors from CNN News having this stone face and we're in crisis and we're going to hell. Market is 25% down right now. And now you have a look at your futures portfolio, and it's pretty much sideways, or it goes down a little bit, but not as much as it looks on TV. That's when you start really understanding the benefit of that. That's when you will stay calm and not overly emotional, because you're diversified. Not all the futures will go down, because that would be against the nature. In times of crisis, some futures ironically can go up very steeply, very quickly, and that's when you start seeing the benefit. If we can get to another slide, that's even more interesting.
Yeah. Here we go.
And now have a look. So this is a comparison between stocks and managed futures in biggest crisis. So we have this Fed hike 1994, long-term capital management bankruptcy 98, dot-com bubble 202, 9/11, and then a credit crisis, the latest huge crisis 2007 to 2009. Stocks, they went down up to 50%. Now have a look. Every single of major crisis, there was blood on street when it came to stocks and indexes. What were futures traders doing and managed futures CTAs doing? They were harvesting money. They were making killing in markets because they were trading low correlated markets, which did not suffer from this linearity like stocks do. It was way easier to manage the crisis with a vast portfolio of low correlated vehicles, which only can be found in futures markets. And that's the point. You need to make money in every circumstance, because you need to provide for your family and pay your rent. And that includes crisis. And by the way, we haven't seen any serious crisis for a long time, and these cycles always have been in markets, so it can be just behind the corner. So what do you do when you are 50% down with your stocks? And what do you do when you're 20, 30, 40% up with your futures? Like, there's nothing else that could give you this luxury when it comes to trading vehicles nowadays. It is not.
Yep. I just want to go back to the previous slide actually and point out something which I thought was quite interesting. I didn't notice this the first time, but I just noticed it then. I think I'm just trying to go back a slide. Here we go. I think you know, stock traders are often like, yeah, I'm diversified because I've got some short strategies as well as long. But what I found interesting is on this chart, you've got a long short equity, which is the grey line there. It didn't really perform that much better than the actual S&P 500, which kind of implies that, well, even if you got short stock strategies, you're not really that diversified.
Yeah. And now we can have a discussion and opinion why we think that this happened, or we can just say, okay, this is another proof that stocks are probably not the best and safest instrument. So let's focus on futures, right? And that's what you and me would do, because we're practical traders, right? We're always driven by practical answers, and we don't see any point in having academical discussions. So again, futures, that's the way, at least from my research, understanding, and experience.
Yeah. We got some good comments and questions in the chat here, Thomas. So let me just put the slide away for a minute.
Yes.
YG's been posting some good stuff. Let me just, this is like a 3-part comment. So I'll read through them and then you can comment on this. So the first one is here. Thanks for the comments, YG. Diversification is awesome historically, not sure in current and forthcoming environment, because, next part, things are different now. All vehicles can go up, down, can go down or up, which were profitable in dark times in the past, like gold, oil, Bitcoin, etc. Completely unpredictable, even in a long run. Wait, there's one more part. But things are changing so much the last 1 to 2 years. Completely different environment for any kind of trading, really.
Well, first of all, things are changing very fast all the time. Like take the book, The Reminiscence of Stock Operator, which is from 1930 by the most famous speculator, and read it. And you will think that you're reading a book from today's markets. Like there are so many parallels, it's crazy. So markets are always changing very quickly. And second, this is just an assumption. Just if you want to see yourself, just again, get historical data of all the futures markets you have. The major one is just like 24 or 25 markets, and plot the correlation table. And then you will see that you will see the whole story, the correlation table. You will find correlations which are low 3 months ago, 3 years ago, 3 weeks ago, because these are different markets. These are completely different instruments. There's no so much intel linkage like in other markets, and hopefully it will stay this way for a while. But I did hear similar questions 10 years ago, and we're 10 years later, and it's still the same story with futures, still the best vehicle to trade. So the question is not really whether it will sustain or not. The question is, what is your alternative? I don't even know why we should think about whether it will or not sustain like this, because we don't have other alternative. That's the truth. We don't have other alternative. So that's right now, it's the best we can do. And again, please prove me I'm wrong, because I still I couldn't find any other way to diversify and achieve low correlations but futures markets.
Okay, thanks for that one, Thomas. Here's a question from Jay Rimmer. Thanks for the question, Jay. I don't have access to futures. Are ETFs a good alternative?
It's very limited. You can have a few ETFs, but it's limited. I personally would make sure that you get access to futures. To get access to futures is very easy. Every decent broker gets you access to futures. We trade with TradeStation. They give you access to all the futures, micro futures. Again, that's a thing of options. So what is your goal? Is it stable income? Then figure out how to get access to futures. It's like when you establish a company. Let's say you want to establish a company which will be delivering goods to people, and you say, but I don't have access to a van. I only have access to bicycle. just like you need an access to van. If your core business is delivering goods to people, you need a van, period. So you need to sell your bicycle and you need to buy a van. So if you want to make stable income, you just need to set your priorities right, and not your priority never must be I have this broker and this platform. No, your priority must be what is it I want to achieve. Do I want to achieve stable income? Do I want to just play some game? That's okay, then do it with whoever broker you want. Do I want to speculate? What is it? And then you need to find tools that will suit perfectly to your intention. But you cannot download some tool and say, I like it, and now figure out what my intention around that tool will be. That's not professional. Sorry, it is not.
A bit of tough love today, but we mean well.
It is a lot of tough love, guys, but
yeah.
I mean it well. Believe me, I mean the best for you, and that's why I'm so direct. So take me with grain of salt, but just we're here to give you our best and to help you, to seriously help you to achieve something meaningful.
Yeah, we got a similar question from James here on CFDs. Also offer a wide range of markets, indices, bonds, and metals. So some of the futures markets that you mentioned earlier. So any comments on those CFDs versus futures?
Yeah, and again, I will again use my tough love approach today. CFDs in some countries like the United States are illegal. And the thing why they're illegal is because they don't have centralized place. CFDs are very low transparent vehicles, very low transparent. And it's easy to make money on paper trading. But believe me, when you start trading live, there's a lot of things that traders do not know what's going in the background, and that's because there's no one centralized place for CFDs, and there's no full transparency with CFDs. We can talk about full transparency and one centralized place or more centralized places for stocks or futures. This is super regulated, super transparent environment where we have just very limited number of exchanges. These are all centralized. Everything goes through this central place, and there's very, very little space for manipulation. That's why we have access to stocks and futures from anywhere around the world, whereas to CFDs, they are completely prohibited and illegal in other countries. So I'm not saying you cannot make money on CFDs. I'm not saying you cannot really use this diversification and correlations. You can. I don't want to be against all the CFDs brokers, because probably there are some honest as well. But again, for me, it is, I'm running a business here, so I need to mitigate all my risks, right? So why I would go with something more risky and less transparent when I can have an alternative which is fully transparent and fully regulated and fully centralized, and my risk in this area is so low that I don't even have a reason to look for an alternative. It just like that's the best it can get, and that's what I want to use for my business, the best that's available, no compromises. Period.
Yeah. Okay, thanks for that, Thomas. Thanks for the question, James. Hopefully that was helpful for you. So I'm just scrolling up the chat because I saw a great question from Renee. G'day, Renee. Here it is. Let me put this one up on the screen. Excuse me. Do you use correlations of markets also as a bias or a weight or multiplier in position sizing?
That's a good one. That's a serious trading question. I like that. Who asked that question?
Renee.
Renee
always got good questions. Yeah.
Mm-hmm. I do, but not really in a sophisticated way. We do have a procedure in my hedge fund, which currently runs on a monthly basis, where we can change the weight of portfolio if we can see some steep fluctuations in correlations. So it's the right way of thinking. It's a good way of thinking, and it does help, although it's not crucial. Like long term, these benefits of changing position size or weights based on changes in correlations, they're pretty much faded with a long-term correlation. But on a short term, for better profit distribution, it can help, and it's definitely a viable and advanced approach. I would say you do not need it from the very beginning, but once you have your low correlated portfolio, you set everything into place, that's a good next step to think about.
Yep. Great question, Renee. Here's a question from Martin, and then we'll move on to the next part of the show because I know we've got some great stuff coming. So from Martin, you started using the word income in regards to futures and day trading many times. Oh, sorry, there's a comment there. Many times before it was discussed so that it's not direct income and we shouldn't depend on the income. Has that changed?
I think there's a misunderstanding. You should not depend on that income when you're starting, because when you're starting, you have a lot of things to figure out or learn or master. And it's same like when you're, starting a company or when you're starting a business. Either you need a lot of previous experiences in the same area being an employee, or you need to have some savings and contingency for your first year or two, so you really know that you have time and cushion to master all the elements. So it's very hard to start trading while thinking that you will be fully dependent on that income since the day number one, and it will even put extra pressure on yourself. So which will make it coincidentally even harder for you to really make a stable income. However, once you get more familiar and comfortable in markets, once you understand these correlations, once you get in touch with this craft, and once you know that you're able to have at least a couple of winning months during the year, and you can get better and better in the distribution of your profits, your confidence rises tremendously, and then there's no reason why you couldn't make it a full-time income. Like, there are a lot of traders, not just me, but a lot of other traders having trading as their only income, and they're dependent on that income because they can trade their way towards regular trading profits. But you cannot expect that from the day number one. It's better to start it as a side business and then just do this transition to full-time business step by step.
Excellent advice, Thomas. Thank you. Hope that was helpful for you, Martin. Now, Thomas, I think we should keep moving because we're going to run out of time soon. So do you want to move on to, is it strategy review time?
Yeah, so I think just let me have a look on my short cheat sheet.
Oh, what should people do next? I think
I think
we're all convinced futures is the way to go. Sorry, Thomas, you can take over while I cough.
So seriously, like, I'm channeling a lot of tough love tonight, but at least I want you to get the seriousness of this topic, because this topic is highly unrated. So I want you to get this into your blood. And where I would start, I would really, great. I understand that some of you guys want to start with small account, maybe try it out, don't want to risk so much, are not on so much money right now. And that's why you're making compromises with stocks or not stocks, sorry, or with forex or CFDs. But you still have this possibility to trade micro futures or mini futures. If you cannot afford to trade mini futures or regular futures, you definitely can afford to trade micro futures. I mean, everybody can afford to trade micro futures nowadays. And that's where I would start. I would just find a broker who allows me to trade micro futures. Again, I and Andrew, we trade with TradeStation. I would find ways to create algorithmic trading strategies on futures, micro futures, mini futures. And I would focus on 3, 4, 5 markets for the beginning, created my first small portfolio, and get in touch with that, like with the reality of futures trading, to get it into blood, to understand, and then I would shut down my eyes, and I would become completely resistant from all these greatest, latest, whatever it is, crypto and stuff like that, because I have different intention. My intention is to create stable income and not be trendy, and that's a big difference. So that's how I would start. And by the way, guys, this is just, can I mention the accelerator now,
Yeah,
Andrew?
sure. Yeah, sure.
This is just a little bit off topic. We're just this week, I and Andrew, once a year we do life coaching program with Andrew and me personally for 10 weeks, and we call it Breakout Accelerator, and it just once a year, and we're opening for January for this year. So if you can post the link, Andrew, please, where you can find more information. So that's another possibility to start with this accelerator program. It will be done shortly, because we're starting on the 2nd of January already. But Andrew just posted in chat, this is this go. Can you read it, please?
Go-bta.com/ACC.
Can you also post it here where we can see
on the screen? Sure,
Yeah.
can. One
So if
moment. I wasn't ready for that one. Yeah.
So that's another way. If you want to join us with this, we will be deliberately working on a portfolio of future markets in this accelerator. So that's another way. But anyway, that's how I would start.
Yep.
So that's about it. That's about markets.
Okay. Well, can we squeeze in one more question from Martin, and then we'll get on to the strategy.
Yes.
So here we go. I know it's been asked many times, but when talking about micro contracts through TradeStation, what is a realistic account, say, for 15 strategies?
5 or 15?
5 strategies, sorry.
5. For 5 strategies, wow, I would have to check, but that would be pretty low. Do you have some educated guess, Andrew? Would be probably $2,000, $3,000?
Yeah, probably a couple of. You probably can do it for 5. So we're just releasing a micro portfolio on Striker, and it's, I think, 8 or 10 strategies, and it's a $15,000 account, which includes all the drawdowns. So I think that's quite manageable. So for 5, yeah, you can probably get 5 to 10K started. I think that's a good way to get started.
Yeah, I think 5 strategies, 5K would be the minimum, but it's doable. It's doable. And it also depends how much you're willing to risk. If you're willing to risk a little bit more at the beginning and open to bigger account, it can be even a little bit less than that, possibly. But I think 5K is a reasonable amount to start with.
That's a great question,
good questions.
Martin. Yeah.
Yeah, good questions, guys. Good questions. Yep. And okay, let me now get to, we have, I saw that Hugo, who posted the strategy, he's here on the call tonight, which is great. Let me just figure out how I share his strategy, and let's do this assessment, because that's a quite, okay, so 1 second. I hope yeah, that's it.
You got it. All right.
Yeah. Can you see the document?
Yeah. Can you zoom in a bit?
Yeah. So I received this from Hugo. So thank you, Hugo, for sending this. And this is a strategy on YM 15/60 minute, which I assume would be using 2 time frames, which of course is a good approach. I like that approach. No trading cost or slippage was used. I would bet that Hugo is probably from Holland or Belgium. I hope that Hugo will share with us based on the name, probably Holland. Maybe Hugo will share with us. So Hugo, this will be, so first of all, thank you for sending this out. We really appreciate that. And the equity curve looks really nice. Even your multi-market validation is not that bad, although it's not it's still not there 100%. But in your case, there's one key thing, and that will make the assessment rather fast, but it also will be a good learning curve. So it goes like this. So during this 10 years, the profit is, let's say, it's approximately 53K. So it's 53K, 53,000. And then we're talking about some sample size about
1250.
1250, yeah.
Yeah.
So we divided by 1250 and we arrived to average trade about $42. So we're talking about $40 average trade. And Hugo, that's really, really, really low, because on YM, you will get one slippage on entry, one slippage on exit plus commission. So we're talking about 15.
You mean one tick slippage, right?
One tick, sorry. Yep. One tick. So we're talking about your transactional cost per trade will be on average $15. And a reasonable strategy needs to have an average trade at least 3, but preferably at least 4 times of your average trade. So ideally, on YM, your average trade should be around 60. That would be my very minimum. And quite honestly, if this is a day trading strategy, your slippage can get much bigger at the end of the day if you're exiting using the exit of the day. So more conservative way would be around 70, 80. That's where I aim with YM, like 70, 80 to be on a more conservative side, but 60 the minimum. 40, it's way too low. That will, even if you put transactional cost and you edit, your equity will change its shape quite dramatically. And even if it wouldn't, the distribution of your profits would be quite challenging in real life trading because of this low average trade. So your first step is good because you have nice looking equity curve, which looks really good on E-mini S&P, E-mini S&P as well. That's a great multi-market validation. It doesn't look so well on EMD. I would be now, when I saw EMD, I would be more precautious. This one is NQ. It's probably because of the
price scale.
I'm a little price scale. Yeah, I'm a little bit tired already. So it would not pass the multi-market validation 100%. So it wouldn't be tradable either way. But it's a good first attempt. I definitely encourage you continuing because it's a good start. But you need to be way more cautious about your average trade. Way more cautious that this would not work. Yeah. So that's all.
I think just a tip for Hugo and anyone else. I think I've had a lot of success with swing strategies on YM. I'm not sure it's a good option for day trading, which I assume is what that strategy was, because there was about 1,000 trades there. So maybe try some swing strategy trades. And we just lost Tomas, but he's back already. Here we go.
I'm sorry. I think I accidentally closed that.
That's okay. Yeah. I was just saying that I found YM is really good for swing trading, not so much for day trading.
Yeah, that's another thing. Yeah.
Yeah.
Okay, so thank you, Hugo. Thank you, Hugo, for sending this out. Did Hugo share with us where is he from?
Yes, from Holland.
Oh yes.
The Dutch name's a bit of a giveaway, isn't it?
Yes. Yes.
Yeah. Yeah. Awesome. All right. Well, we've got a couple more questions in the chat, Tomas, but we've also got our motivational quote. So you choose. Which one would you like to do first? You can choose today.
Well, let's do questions.
Okay, let's do questions. All right. This is a great question from Bill. This is awesome. Hang on, I'll just put up on the screen. Thanks for the question, Bill. If we can do only one of these two approaches, which one would be better? One market diversified over several strategies, or diversified several markets with one strategy?
You know my answer, Bill, that I would not pick. This doesn't make sense to pick either or, where I can have both, and that's the sweet spot, right? Like that's compromising again, and we do not want to compromise on our business at all. So for me, this question is not even relevant because it's out of my consideration. But to give you answer, if I would have to, with a gun on my head, I would pick the second one, several markets with only one strategy. That's what I would pick.
Yeah, I really like this question. Oh, sorry.
Yeah, that's a good question, Bill.
Yeah.
But in reality, I wouldn't pick either.
Yeah, I think traders see like two paths, right? They can diversify. Sorry, they can specialize in one market and diversify over different trading styles, or they can specialize on one style, which is what you do, and across multiple markets. So I think that's a great question.
Yeah, good question, Bill.
Yeah. Okay. Okay, and then we got a question here from Martin. Let me put this on the screen. What is slippage on micro contracts? Imagine this. It's not in one contract, but 1/10 for the same strategy. So what's the slippage on micro?
Martin, I'll be honest, I do not trade micro. I only trade full contracts. So I don't have experience. I only know that the volume sometimes even exceeds the mini already. So the slippage will be pretty low, maybe even better in some cases than in the case of regular contracts. I don't know. Do you have some experience, Andrew?
No, I don't. I don't trade micros yet. So.
But I wouldn't be so preoccupied. Honestly, no, because the volume is really increasing and it's really good, and that would be least of my preoccupation.
Yeah, I imagine the slippage is probably less than other size contracts. So
it's possible.
Yeah. Okay, so that looks like the end of the questions right now. So Tomas, motivational quote from. I was surprised to see this one actually from an economist. Oh my goodness! When I saw the name, I was like, "What? What is this?" John Maynard Keynes, who is a British economist, very famous guy who was, I guess, the father of Keynesian economics. So let me put this up on the screen, and you can explain what this means and why you've chosen it. Here we go, coming right up now.
Yes. This is. I know it sounds a little bit weird, and it's even from economists, but there's some inherent truth in that, and that's very important. And it is better to be roughly right than precisely wrong. That exactly fits perfectly with diversification, because if you're well diversified and if you trade different strategies among different markets, the thing is that you can be just roughly right, like something occasionally needs to work for you to make money. But now imagine you have one strategy, you run that strategy on 12, 15, 20 markets, and that strategy will be precisely wrong. You get the point now? That strategy will be precisely wrong on 20 markets, so you will lose. You're not diversified. So it's better to have these different strategies on different markets, and you always be roughly right or roughly wrong in the worst case, but at least you're giving yourself a good foundation. But with so many markets exposed to one strategy, you can be precisely wrong on all of them, and that will be painful. So that was the abstraction of this quote. I know it's a little bit abstract, but yeah.
That was a great explanation.
Okay,
I like
good.
it. When I first saw it, I thought, what is Tomas? How's he going to apply this one? Let's see how he gets out of this. I thought I stumped you, but yeah, it makes complete sense. So thanks for sharing that.
Thank you.
Okay, we just got a message in the chat from Raibu, signed up for the accelerator class. Looking forward to it. So can't wait to
looking forward to work with you. Yeah, great.
Welcome. And
welcome.
One more question here from Martin, and then we'll wrap up for today because we're just about on time here. Martin's had a bunch of good questions today. Do we have any recommended software to compare multiple markets, same strategy? Also, do you have scripts that export equity curves, say, into Excel in order to compare them as a group?
Quite honestly, my hedge fund team does all this technical stuff. So maybe if you have some tip, Andrew.
Yeah, so obviously TradeStation has reports in it. I don't know, I haven't used their portfolio software, but there's other, you can do scripts that export trades, and then you can import the trades into something like Market System Analyzer, which is a good product for that kind of thing, or Excel. So if you're using TradeStation, it's very easy to export trade lists, and then you can run the data from that. So that would be my recommendation.
Yeah, I agree with Market System Analyzer. I totally love Market System Analyzer. Been using it for a long time, and they provide a code already, which you write one line at the end of your strategy in TradeStation. It automatically exports the CSV or TXT files, and then you import it in Market System Analyzer, where you can also put your correlations and other stuff. Yeah, so I forgot about this one. That's what I used to use before my hedge fund for many years. That's definitely my favorite Market System Analyzer. We cannot hear you, Andrew.
I put myself on mute to have a cough, and then I forgot to take it off. So thanks for the question, Martin. Hopefully that helped, and you've had a lot of great questions today. So thank you. So Thomas, we've come to the moment, the very sad moment. This is the end of the 5-part series. I'm interested to know in the chat, actually, what did you think of this series? Did you like it? Did you get some value from it? Should we keep doing it? I guess that's the question.
That's a good question.
Next year.
Should we keep doing it? Yeah.
I don't know about you, Thomas, but I actually I enjoyed this. I like talking to traders and having a chat to you about trading, and it seems like we're building a nice little community here. So yeah, I think there's a lot of value in what you're sharing, and it'd be good to get it out to more of the world. How do you feel? What should we do here?
Yeah, it was very enjoyable, and I have to say we had quite a good audience and great questions, which I really enjoyed, this interactivity. So I mean, like, guys, you're awesome that you keep popping up and asking these questions. This really makes it enjoyable that we can communicate here. And I would be open to continue, but I have to warn you guys, sometimes my life will be even tougher because I want you to get results.
Well, that's what we need, right? I wish if I probably had some more tough love at the beginning, I would have progressed quicker, right? So, yeah, so we're getting some feedback.
No mercy.
No mercy. We're getting some good feedback in the chat, Thomas. How about I share some of these, and we'll start wrapping up. So, Jay Rumor, it's a very good series. Thanks, Jay. Martin, keep on rolling. Renee, always good questions from Renee. Love the series. Give me more. Chris says, very informative. Thank you very much, Chris. YG, that's a great podcast. Thomas is awesome. Hey, what about me?
Yeah, exactly. What about Andrew?
I'll try and do better, YG. Don't worry. Next year I'll get better. Just joking. Hugo, keep it going. Bill, excellent. Keep on doing it, please. Okay, we got more. Oh, hey, Monroe. Monroe's here. Absolutely like the series. Very interesting. Good day, Neil. I didn't see you joining us. Keep it coming. So, I'm glad we didn't get any bad responses there, but I probably wouldn't have shown them anyways. And Jay Rumor, actually, I'm going to put this one up because this is dedication. 4 a.m. now in the Philippines. That's that's commitment.
That's dedication. That's commitment. Yeah.
I'm sure it was well worth getting up early. So, yeah, thanks for that. So, I think maybe what we'll do is we'll sneak in a special little series just after Christmas. What do you think, Thomas? Should we do another one?
Why not? Yeah, let's see what happens.
Okay,
yeah.
all right, excellent. So,
but you guys need to give us thumb up and subscribe.
Oh, yes, exactly. Thumbs up and subscribe. And we're going to release some additional content on the YouTube channel soon. So don't want you to miss that. And the only way you get notified is if you hit the little bell icon guy. It pops up on your screen. So thanks again for joining us today. Thomas, do you have anything that you wanted to mention before we wrap up?
Not today. If you have something today, I pretty much said it all.
Yeah. Okay. No, that's it. So thanks for joining us in this 5-part series. Hope you found, or we know that you found it very valuable. So let's keep it going, and we'll catch you again very soon. So thanks a lot.
Thank you very much. And oh yes, Merry Christmas, guys.
Oh, yes.
Yes.
Merry Christmas.
enjoy your holiday. Have a great Christmas, and
Yep.
yeah, get some rest, enjoy it, and see you back after the Christmas.
All right. Ciao.
Hopefully. Ciao. Bye bye.